Hello, everyone, and welcome to our quarterly Diamond Trends webinar. It's great to be with everyone again. I hope you're all staying safe and healthy and warm. I know it's very cold in many parts of the world, and I hope you had a good holiday season and that the momentum has continued into 2021. I wish you all a happy new year. This is our first time that we're meeting in 2021 for our quarterly webinar series. It's been going on for, I think, almost 2 years now. And as always, we've got a number of goals that we want to set ourselves for the next hour or so. And so the first thing is that we're going to take a quick look at the holiday season and put it into some perspective of how retail performed during the important Christmas through Chinese New Year period. And we're going to try and put that into the context of the larger diamond market and look at the supply and demand factors that are driving the industry at the moment and influencing prices in the first quarter of 2021. And that'll take up the bulk of our discussion today. And then we're going to spend a short bit of time just looking at some of the trends that are really defining and characterizing the diamond markets at the moment and moving forward, both short-term and long-term. So I'm going to try and speak for about 45 minutes to an hour, and then we'll open up the floor for some questions. If you have any questions, feel free to put them in the Q&A section of the Zoom app. So thank you for joining me, and let's get going. I think when we look at the holiday season, it's very difficult to make a blanket statement, or it's very easy to make a blanket statement that the holiday season was good, holiday season was bad. Truth is, it's mixed, and sometimes it's good for some, it's bad for others. But I think when we look at 2020 holiday season, there's a context, in the context of the very difficult year that we all went through last year with the coronavirus, and with business being shut down for a period which is unprecedented. And so there was a period earlier in the year, say April, May, June, July, where we were thinking, if we look towards that holiday season, what's going to happen? And I think expectations were quite low. And so when the holiday season did come and there was activity, I think we were all quite relieved. And therefore, I think in that context, there was a positive feeling all around for the holiday season. And that stemmed from both independents, anecdotal reports that we got from independents, and also official reports that we got from the majors, which is what you see on the slide. So what do we know from the majors? That Signet Jewelers reported flat sales in line with 2019, which is a good accomplishment, I think, at about $1.8 billion. Tiffany saw its global sales up 2%. And then the major sort of luxury houses, LVMH, Richemont, which owns Cartier, Van Cleef, saw their sales down 5% and 8% respectively. Pandora, which is not a diamond jeweler, but a big jeweler, nevertheless, saw its sales down by 1% for the holiday season. And so I think it was relatively positive and gave some confidence to the trade in general. I think that there were some standout numbers that were fairly consistent across the board when we looked at the major jewelers. The first was that China in the fourth quarter seemed to have a very strong recovery. Tiffany, those luxury houses that have an exposure to a global footprint like Tiffany, LVMH, Richemont, really saw their sales lifted by China, up 50% for Tiffany, for example. The other standout number across the board was the growth in e-commerce that we saw. Signet seeing 61% growth, Tiffany up over 80%. It was quite staggering and quite eye-opening as well, the extent to which the industry was able to pivot to digital in 2020 when it needed to. And so beyond that, we picked up on there were some themes that did come through on a consistent basis about during the holiday season. The first is that the season started earlier. Already in October, we were hearing retailers talk about holiday sales. Usually, the holiday season is November, December, and even from the Thanksgiving weekend is usually viewed as the official start of the holiday season. But already in October, people were talking about holiday sales, and that's understandable. I think consumers saw that there was a window to shop at that period, and it wasn't clear if stores would be open later in the year, so they took that opportunity when they could get it. The other aspect is that they wanted to avoid crowds, so went shopping earlier, rather than being caught in that last minute rush that usually happens around the holiday season. And then, of course, there was the online aspect where there was a concern earlier in the year that if people are making all these online purchases, if delivery was going to be a problem, so people made those orders maybe a little bit earlier to ensure that they get a delivery in time for the holiday season. From what I see, that delivery wasn't an issue. It was a concern that petered out in the end, and the deliveries, the delivery companies managed the high volume of orders that needed to be filled. The other thing about the holiday season is that the jewelry industry really was able to capitalize on the lack of travel. The end of year is a popular time for tourism, both from a leisure point of view and also people going back home to visit family, etc. And due to the lack of travel because of the coronavirus, people had more to spend on gifting, and the jewelry industry, I think, was a beneficiary of that. Thirdly, local businesses, people turn to local, and that's on an international basis, particularly when we look at the Chinese tourist that has such a strong influence on sales at flagship stores in important centers like in New York, Paris, London. That Chinese tourist was not around. Because they couldn't travel, and so they spent more in mainland China, and I think that's also where we saw that jump in retail sales in China, with those companies that have a presence on the mainland, able to take advantage of that. Also in the US, there was a general feeling, I think, that people wanted to support their local community businesses. Businesses had a tough time during the lockdown period, and so there was a sentiment, I think, to support local, and that's where I think your local independent community jewelers, so to speak, really were able to get some traction in sales from their immediate community. We've heard a lot about the sentimentality of that came through during the pandemic, and I think that did play a role in gifting, that people did look for meaningful gifts to give their loved ones, people that they had shared such intimate moments during the lockdown periods. That people put more thought into their gifting choices. And again, the jewelry industry, we know, is perfectly positioned to take advantage of that. And I think it did benefit from that sentiment. And then, fewer better things has become a bit of a cliche in the industry, but I think it's such an insightful term. It's a message that De Beers came up with initially, I think, and they reinforced that in times of crisis, people do look for fewer things, but more meaningful things, and maybe more expensive things even as well. So if they're spending, if they have a budget, but are spending on a gift that really counts, and I think that is true, and I think it's a very insightful thing insightful characteristic of the market, particularly in times of crisis, that De Beers picked up on, and I think it was true during the holiday season. And then finally, as we mentioned earlier, that e-commerce was the growth driver for the industry during 2020, and particularly in the holiday season. And the perception that was out there about consumers not willing to buy jewelry online without being able to physically feel and touch the stone and see the piece on before making the purchase proved not true in the end. And I guess that necessity is the mother of all invention, but really that the industry invested in improving its omni-channel offering even before the pandemic. In fact, it was before that pandemic, so that it was well positioned to take advantage of this period where we had to pivot to digital. And so we saw companies such as Signet Jewelers, Tiffany as examples, being the major jewelers that put their programs out there. But I think many others followed the lead in the last 3 years that really made an investment in online and making sure that they're where the customer is. And the customer is not only in the store, it's the customer is very much online and in various channels. And so we saw this spike in online sales across the board. This is an example of Signet Jewelers, which is the one major jeweler that in the United States, at least, that we have access to their data because they're a public company and publish the information. But we see that in the fourth quarter, or at least in the holiday season, that online accounted for 23% of their total sales, and that's a big jump from previous periods. And it'll be interesting to see to what extent that momentum continues. That it does generally spike over the holiday season, as we saw in previous years as well, but I'm not sure if it'll reach that 23% again in the coming year. We'll see. I would imagine that it's maybe just under 20% or somewhere between 2019 and 2020's number, because it was an anomaly year. People will go back to the store, but it's all one really now. This the in-store experience and the online experience is really just becoming enmeshed with each other, and jewelers are cognizant of that and certainly investing in it. But for our purposes, we see that there was the spike in online jewelry sales, both at Signet and the rest of the markets in the fourth quarter. So when we look at the full year in 2020, we want to assess how the jewelry market has performed. And when we look at the major jewelers who are public companies, and we have access to their information, some of this is our estimates, but combined, these companies' sales fell by about 17%, and we're seeing other estimates in a similar range. The Bain report, which I encourage everyone to read, which came out a week or two ago, also had an estimate around the same range. I think they said that jewelry sales fell by about 15% in 2020 as a whole. So it's probably between 15 and 20% for the year. And if that is the case, if it's 17%, this is what jewelry sales looks like in the context of the last decade. That we saw a similar drop-off in 2009 with the financial crisis, and then there was a gradual recovery, and we saw jewelry sales peak in 2019. According to these are numbers published by the De Beers Diamond Insight Report, which is another fantastic report that I encourage everyone to read, that comes out on an annual basis. But they haven't put out their 2020 numbers, but based on that 17% decline, this is what it would look like for 2020. And so when we look at jewelry retail sales, you know, that as a whole the industry did decline in 2020, as one would expect given the circumstances of the pandemic and the lockdowns that we experienced. But then the question is, how do retailers approach their inventory when their inventory? How much, based on their sales and based on their experience and the state of the market, are jewelry retailers going back into the market to buy loose diamonds and have that ripple effect across the rest of the trade? So how do they look at inventory in the context of that decline that we experienced last year? And so there are a number of factors that are impacting jewelers' inventory decisions at this time. Firstly, they had lower sales. So one would say that if they have lower sales, they were probably holding some stock over from the previous year or previous period. I'm not sure if that's a real calculation or not, because I think they do buy inventory as they go along, and so as the market shut down, they didn't buy goods. And certainly, I think in their preparation for the holiday season, they were very careful in aligning their inventory with what they perceived to be a lower demand for the year. But there are other factors involved as well, and we are seeing, I think, over the last decade, since the 2008 financial crisis, that jewelers want to hold less inventory, because when the financial crisis happened, before 2008, they were holding. Jewelers were quite willing to buy in bulk and hold goods in their storerooms, in their safes. And then when the financial crisis happened, they were left with inventory that had declined in value and that they were not able to move. So they wanted to minimize that risk moving forward. And I think that was generally the change in mindset that the financial crisis brought. And that played out again to some extent, I think, last year, with the coronavirus crisis, that jewelers wanted to hold less, they want to minimize that inventory risk. And one of the ways they're able to do that is to take more goods on memo, and that's been a trend that we've seen over the last number of years, that jewelers are taking more goods on memo, that those are goods that they can hold and not necessarily buy. In other words, they're taking the goods and only paying for them if they make the sale. Otherwise, after a time, they return those goods, and it's a way to mitigate that inventory risk for them. We've spoken about the impact of e-commerce on inventory, on retail inventory before, and I think I think it's something that's going to only strengthen over time. That if you think about the internet, it's really this massive, this wonderful, massive, diverse showroom for a retailer, that they have access to their suppliers' goods that they can show effectively online. And that broadens their access to inventory without holding the inventory, essentially. And both if they're making the sale in store using technology to improve to broaden the consumer buying experience without having the goods on hold. And if you think about also that if as more jewelers are selling only online, that they need less inventory in order to do so. You know, that if, you know, compared to a jeweler who has 3 stores and has to fill that shelf space with goods, whereas the online jeweler just really needs to show the image and have an effective viewpoint for the consumer. And if the sale is made, they can make the order from their supplier in real time. And so all these factors, I think, are playing into the requirements that retailers have in terms of their inventory moving forward. And so that begs the question, you know, what volume of goods is required for the industry? And it all stems from demand. It all stems from the retail sector. But these factors are playing into that decision. And I think it's a question that I'm particularly interested in the mining companies, how they grapple with that. Because I think this is the question that they're asking themselves every day as they plan their rough production and look at their operations. You know, how much rough is needed to satisfy demand in the market. And I thought it would be an interesting and kind of fun exercise to compare rough production by value with the jewelry sales value that we showed in the previous slides. And so the orange number, the orange bars are rough production. And the line graph in this slide shows the percentage of that rough production versus jewelry sales. And it's quite interesting, I think, because on an average over the last decade or so has been 17.6%. In other words, the value of rough production is generally about 17.6% of total jewelry sales. It's exceeded that in a number of years. In 2008, it exceeded that. In 2013, 14, and 15, that percentage exceeded that 17.5% range. And again, in 2017 and 2018, and each of those periods were periods of were difficult periods for the market, where we saw there was particularly if you think back more recently to 2017, 2018, that there was an oversupply on the market, and we see that in this proportion of rough sales versus jewelry sales, that it was over 18%, and it seems, and this is really kind of a back of the envelope exercise that I did, but it seems that there is a sweet spot that the rough producers would be aiming at, and I feel like we're kind of in that sweet. In fact, I feel like we were kind of trying to correct into that sweet spot in 2019 when rough production came down, but actually jewelry sales peaked in 2019. And today, in 2020, the that percentage, that proportion of rough versus jewelry sales fell below 15%, and that's maybe too low. As we saw that there were shortages coming in, shortages being reported in the market, certain categories you couldn't find the goods that were necessary. So, as I said, I think there's a sweet spot, but I think it would need, a range of maybe between 16.5 to 17.5%. I don't know. It needs a bit more analysis, but it's a fun exercise, and I think an interesting one. And I think it's a question that the rough producers are asking themselves on a continual basis. Because if we look at rough production, prior to the financial crisis, that percentage was probably through the roof. We were probably looking at around 20% of global sales that the rough market was producing. That was too much, and so after 2008 in the financial crisis, the industry set a new norm of rough production, which was pretty consistent between 2019 to 2016. And 2017, we had a bit of a spike in production as the Gachagua mine came on board, Renard, Likabong, new mines which had fair volume added to the global production number, and that peaked in 2017, and then it started to correct again in 2018, and certainly in 2019. Having endured the crisis of 2020, we forget how difficult the market was in 2019, and 2019 was a year where there was too much goods in the market, and so the manufacturers pulled back from buying rough at those price levels, and so production came down in 2019 as demand fell as well. And certainly then in 2020, rough production came down again as mining companies had to close. Some mines were closed. The Kati mine was the most significant of those which closed, and mining companies had to reassess the level of demand. Had to ask that question at these new lower levels of demand: what sort of production do we need to put out there? And so that's where we were in 2020. And I think we do have to give the mining companies, particularly Alrosa and De Beers, some credit in how they handled the market and how they handled the market situation, and we see that in the rough in their production numbers as well, not only in their sales. And so when we look forward, it's a question: what are the mining companies asking themselves now, or how are they assessing the market? And maybe that'll give us some indication of what we can expect in terms of how they view consumer demand coming back. I'm not sure if we can extrapolate on that, but it's interesting to see some of the forecasts for rough production in 2021, that the major miners that are public companies and publish their numbers is what we have access to and what is presented here. So Alrosa, De Beers, and Rio Tinto, which are the three major producers, or at least they were in 2020, have provided production forecasts, and we see that Alrosa in the mid-range of its forecast is looking at a decline of about 3%. De Beers reduced its production in 2020 and is looking to increase again in 2021. Rio Tinto, which owned the Argyle mine, closed the Argyle mine at the end of last year, and the Argyle mine was in its final year produced I think it was 10 million carats worth. It was still the largest producing mine in the market. And so now that is not in the market anymore, and that has a significant impact on global production moving forward. And we see that so Rio Tinto is left with its Diavik mine, and so its production is going to come down by 11 million carats in 2021, according to its forecasts. And so if we take these public companies, not all of them, the rest, excuse me, the rest have not provided a forecast, but just sort of my own rough guesstimates. We're looking at the combined production of these companies coming down by 7% in 2021, by some 5.5 million carats, and that's not an awful lot. But if we look at the rough production number, that I would say that we are looking at this, you know, if the financial crisis sets a lower norm for rough production, I think that the coronavirus crisis is going to do the same at a slightly lower level even as well. And I don't expect production in 2021 to be lower than 2020, but I don't expect it to be too much higher either from a volume point of view. I do think that that by value, there will be some growth because rough prices have come up already. But if we're looking at 2021, we're looking at about, you know, that 5.5 million carats is actually not hard to fill when you consider a number of things. That firstly, that a number of mines that have closed down, that closed during the coronavirus crisis, are coming back on board. The Kati mine, I think, is again the most significant of those. It's a 4 or 5 million carat mine that wasn't operating in 2020. Similarly with Renard and Likabong, and so that'll fill that 5.5 million carat gap. I do think there is something to be said also about lab-grown diamonds, synthetics, filling the Argyle gap. Argyle was famous for its high-value, beautiful pink diamonds, but the bulk of those 10 million carats were lower value run-of-mine goods that were just about gem quality, let's say. You know, that they were used in jewelry, but they were used in a specific way to fill a pavé setting or you know, for high volume use. And so the question comes for you know, for jewelers, that perhaps they will want to, they would rather use a higher value synthetic diamond than you know, as a replacement for a lower graded stone that might have come from Argyle. And that's it's something to think about, and I think to be aware of. I don't think, or I don't know that it's happening on scale at this stage, but I think it's in the discussion at least, and I think it's something to consider. And I think it's also affecting the production decisions of some newer or smaller miners that might have that perhaps saw themselves as a part replacement of Argyle, and maybe are not are making a different calculation today because of the lab-grown market. But the lab-grown market is a completely different discussion that maybe we can get into another time. Another aspect of production and the potential shortfall of production is that there is a certain volume of existing inventory in the mining sector. And I spoke about this quite a bit last year, that I was concerned that the mining companies were producing goods, whereas they weren't selling very much in the second and third quarter, but their production continued. And so I felt that there was going to be a buildup of rough inventory at the mining level. And the truth is that didn't happen. and that's largely because of a very strong fourth quarter bounce back that we saw. But I think it was credit to the mining companies that they foresaw this and sort of saw and sort of managed to produce what they were able to sell in 2020. This graph shows production minus sales volume. So at those public companies that I showed earlier, except for Rio Tinto. Rio Tinto does not provide sales data, sales volume data, so they're not included here. But the combined production minus the combined sales of those remaining companies shows that there was a buildup of inventory in 2019 and only a slight buildup of inventory in 2020. But again, if the combination of the last 2 years is that 5.5 million carat shortfall, so that would make up for that those goods are in the market. It's not a really accurate account for mining inventory, because we know that for example Alrosa has reported that it has 20 million, some 20 million carats in its inventory as of December 31st, and it was about 32 million 3 months earlier. So it reduced that, but it's still got quite a bit of quite a few carats to sell to the market. Anyway, I think there is an existing inventory of rough out there that is again influencing the production decisions of mining companies moving forward. As I said, that reduction of mining inventory was really because in the fourth quarter, the rough market really woke up, and we saw a really nice recovery. If you're looking at it from a mining point of view, I guess a strong recovery in the fourth quarter from those lows of the pandemic. In the second quarter, the market came back quite strongly, and I think again, if you think back to that previous graph of the percentage of global production versus sales, those shortfalls started to show in the second half of 2020 that required manufacturers to go back into the rough market. The momentum has continued in the first quarter. We saw January sales, and this is the combined sales of Alrosa and De Beers by value, that we saw just in January that there was very strong sales at both companies, and this week is the Alrosa sale, next week's the De Beers site. We'll see if it continues. But what I think is happening at the moment here is that we see that there's a return to a normal selling cycle in the rough market, that traditionally or historically we've seen a spike of rough sales in the first quarter, and that would be followed by lower sales in the subsequent second and third quarters, in particular. And we saw that in 2013, in 2014, 15, not so much in 2016, but certainly in 2017 and 18. And that cycle was broken in 2019 and 2020. And I think what's happening now is that there's a return to that normal trading cycle, that we're going to see a spike in the first quarter, and I would expect some sort of a drop-off in rough sales in the second quarter. It remains to be seen. I think if we don't see that, then we start. If we see another strong quarter in the second quarter, then we need to start worrying about too much rough coming to the market. And I know I wrote about my concern for a bottleneck of supply in our most recent research report. And I think my point is still holds, that if that momentum continues into the second quarter on the rough market, then we need to worry about an oversupply. I think there is something to be said about the trading cycle, the seasonality of the diamond trade. The fourth quarter is the major retail selling period, and so retailers have diminished their inventory, and then they go back. They need to come back into the market to replenish inventory at some point, generally sort of in the second quarter, I think. And so manufacturers need to prepare for that inventory replenishment, and so they buy rough in December, January, February, March in the first quarter, and that's why we see the spike in first quarter rough sales, and then the polished market goes into action, and the cycle starts again. And so maybe it's I think that it's as I said, that the healthy cycle would be a strong first quarter, and then we'll see what happens in the second quarter. Because at the moment, the market seems to be in a relatively healthy space when you think about the supply-demand dynamic, and we're seeing on RapNet that while inventory has increased quite steadily since July, and continues to increase in February. It's not at outrageous levels, and it feels like the market is for the moment in some sort of healthy position. Some sanity seems to be happening, and that's a result of the unintended. I don't know if unintended is the right word, but that was one of the benefits of the coronavirus crisis, is that the industry was able to rebalance its supply with demand. It's just that where that level is perhaps at a lower level than we want it to be, but the market's in balance, and that's why we've seen some a good recovery in terms of polished prices. That our RAPI index it came down in the first quarter, as we know, in the first quarter of 2020, and then there was a gradual recovery, particularly in the 1 carat was quite a gradual recovery in the 1 carat through the rest of last year. And we are seeing some stability, I think, in those prices, in the RAPI index in the first half of the first quarter of 2021. And the 50 pointers, the half carats, which is the orange graph on the top, and the 30 pointers, which is the blue line, show a bit of a different story. And the half carats really came back very nicely, quite aggressively, in the second half of 2020, and then from around mid-October, we saw some sort of a correction in those in that RAPI category. RAPI is made up of the top 25 categories. The average top. Let me phrase this carefully. It's the average of the top 10% of the top 25 quality ranges of diamonds. So that's the top 25 categories are D to H color and IF to VS clarity goods, and we take the top 10% and average that out to get to our index. And so we've seen a gradual correction in both the half carats and the 30 pointers since around October. And that's again, that's kind of continued. Into 2021, and we see here, as I always like to show this this graph for historical context, that as far as the quarters goes, ago, we saw a nice that big drop in the first quarter of last year, and nice recoveries in the second, third, and fourth quarter. And the 1 carat Rappi is relatively stable at the moment. And but it doesn't really tell the full story of the market. And again, because the Rappi is showing it's an average of the D2H IFVS goods, and there are other categories out there. But what we've seen in the market, and I think it's sort of played out since around October time, maybe a little earlier, is that there has been a shift to lower colors and lower clarity goods. The initial recovery of the market was in those D2H and those higher clarity, higher color goods that really characterized the recovery. But then there has been the shift to lower price points in the last few months that we've seen. And this graph is presented in our research report that we publish every month, that shows the time of removal for new inventory listed on RapNet. So this is showing inventory or diamonds that are listed on RapNet in December. We look at how long it takes for those goods to be removed from RapNet. And so, granted, a stone can be removed for various reasons. The supplier may just take the stone off the platform, but generally we have a fairly high retention rate, and we're able to assess that most of these goods are transactions, that they're sales. And so we're seeing that shift to lower colors and lower clarities in this graph. And it's that diamonds that were listed on RapNet in December in the D2H colors were moved at a slower rate than they did a year earlier, by quite some margin. And we're seeing that certainly in the higher clarities as well, the SI goods was pretty much in line with last year. Sorry, the dark blue graph is the percentage of goods that were sold within the first month of being listed, and the lighter blue on the top is within the second month. So for D2H IFVVS, 51% of new inventory listed on RapNet in December sold in January, and 12% sold then in February to date. But that's lower than a year earlier. In the I2K colors, we're seeing an increase in compared to the previous years. That in the higher clarity, almost it's across the board in IFVVS goods, VS goods, and the lower color and lower clarity SI goods as well. That there's an improvement in the movement of goods on RapNet. And we see that we see a similar story playing out in terms of prices. That when we look at the average price movement in the last month, I think it was the 15th of January to the 15th of February that I took it, that we're seeing some slight negative numbers, not crazy, but mind you, a decline of 0.8% on average for D2HVS is some movement for an index. But then we're seeing some positive numbers in the D2HSI, the lower clarity goods, and then the lower colors as well. The IFVVS are up 3.5% on average for that 1 month period. And we're seeing, and I'll go through this fairly quickly because I think I've made the point, we're seeing a similar pattern in the half caraters, where the D2H, the higher clarities, is performing worse than previous year. The SIs are seeing an improvement in the D2H, And the I2K, the lower colors, are up across the board, and we're seeing a similar story told in terms of the price movement in those goods. And again, this is not the price list. These are average prices that we're seeing on RapNet. And it's and the 1 carats are showing a bit more stability in terms, across the board. In fact, the DH IVVS goods are showing an improvement compared to a year ago. In fact, there's pretty much an improvement across the board, and some stability in terms of prices. And the question we ask ourselves is, what is influencing this shift? That and the truth is, I'm not sure. It could be that the D2H goods, the higher color goods, peaked around October time, and now so they became maybe too expensive, and people shifted their preference to lower price points. I'm not sure. It requires greater analysis. And one explanation we thought of was maybe it's the Chinese market, that particularly on those 30 pointers and the half carats and the D2H colors, is very much a Chinese product. But the Chinese market is off the market now, because now is the Chinese New Year. But from October till January, February, it was still an active market, and so it wouldn't have influenced a decline as we saw previously. But it requires greater thought, and those are just theories that I'm throwing out there, and certainly I wouldn't. It doesn't seem that the data is supporting particularly that China story, but it requires greater thought. Anyway, so where does that leave the midstream in terms of its inventory management? We spoke about the retail markets requiring less goods, less inventory. We spoke about the rough market, trying to pinpoint what the appropriate production would be. But what about the midstream, manufacturers, dealers, suppliers of polished diamonds? Because there's so many factors at play, and I think I've tended in the past to say inventory's bad. There's too much inventory in the market, but the truth is that a supplier of polish needs inventory to effectively service their clients. If the jeweler is not holding its inventory, they're at least relying on their suppliers to have the inventory. And so the polish supplier needs that inventory. On the other hand, as we've seen in the past, too much polished inventory has a negative impact on the market. A negative impact on too much supply that is not aligned with demand brings down prices. And so so going back to that sentiment that suppliers need inventory, as they need inventory also for because as memo is increasing, jewelers are taking more goods on memo. They need the inventory to supply that memo. I once asked the question to a polish supplier who's a big supplier of goods and relies on the memo market in a big way, and he said inventory is not bad. I need my memo. I need inventory to be able to supply goods on memo in an effective way and in a broad way as well. Another interesting aspect, which may be just a coronavirus feature, really, is that more goods are going out on consignment, and by that I mean that people are sending more goods to their retailers just to look at, and then it comes back immediately. So whereas before the lockdown and the travel restrictions, you would have your sales rep going to the retailer and showing them goods, or dealer to dealer showing goods, and that is not available anymore. and so retail, so polished suppliers are then are sending goods to retailers to have a look, pick out what they want to buy, and sending the rest back. And one feature that we picked up on is that that in a way, or to some, that's actually advantage and a good thing. Advantageous, is that a word? Where a polished supplier is able to show goods that a jeweler would have dismissed the salesperson with by just sending them. So they require a certain amount of goods, a certain quality of goods, and the polished supplier says, you know what, I'll just send this as well, and if he doesn't like it, they'll send it back. And sometimes that results in a sale. Whereas the salesperson would say, well, you know, I've also got this quality or this category of goods. Do you want to see it? And he'll just wave him off and say, no, I don't want to see it. So it's kind of an interesting dynamic, but it obviously doesn't work for everyone. Anyway, those are considerations for manufacturers when looking at their inventory. Another thing that's happening in the polished market, or if it's not happening at the moment, we expect it to develop, is that more goods are going to be manufactured in Southern Africa. Botswana wants more goods manufactured locally, and that's part of the deal that we expect to be agreed with De Beers as they negotiate a new partnership agreement this year. And already De Beers has said that it will provide more goods, more higher quality goods, I think at least, to be manufactured in Botswana, and that changes the diamond route, the route that the diamond travels before it gets to its customer. Whereas before, the rough would travel, or the polished would travel, to Dubai, or to Antwerp before going to India for manufacturing, and then shipped back to Israel or Antwerp before it's shipped to the United States or Hong Kong, whatever the case may be. The Botswana may emerge as a polished distribution center, not only a rough trading hub as it has developed, and that's something to keep an eye on. And then finally, manufacturers and the midstream is also looking at how to become more efficient in its rough purchases, in its polished trading, in its polished manufacturing, and really, and that involves really understanding their customers' needs, where the diamond needs to be before it's as it goes through the diamond distribution chain. There's much greater transparency and access to information about rough purchases, that the rough buying is really shifting towards being more demand driven. And there's a greater use of technology in the midstream as well, and an improvement in turnaround times in manufacturing. So the manufacturing sector, the midstream, is gradually becoming, or maybe even quickly becoming, more efficient as we shift into this new reality after the coronavirus. And so that brings us to some of the when we look in hindsight and in context, what is influencing the market in the long term. And we did this exercise in our January webinar last year, where at the beginning of the year was the beginning of a new decade, and we made some predictions about, not necessarily predictions, but observations of what we expect will influence the diamond market over the next 10 years. But so much happened in 2020 that one would think that that perhaps those themes would have changed. But the truth is they did not change. They intensified, and really these themes that are listed 1 year ago are only being accelerated and being talked about and discussed and strategized about in a much more intense way. And so we expect an acceleration of these themes, if anything, as we move through what we hope will still be the roaring 20s. And so these 10 items or themes are as follows. The first is that we expected already last year that there would be a lower rough supply, and as we spoke about earlier, that has become true as we expect the global production to stabilize at a lower level moving forward. We spoke about the changes to rough buying, more sort of demand-driven or supplying rough according to the polished demand that's required, and that has transpired in a more meaningful way in 2020 already, and will only intensify moving forward. And we spoke about the mining sector consolidation, and this is something that I think will still, it was unforeseen circumstances last year that influenced this, as certain mines had to close and some companies came under financial distress, and so there were deals made. But I think, and so that changed the landscape a little bit, but I think it will continue. That will continue without the coronavirus influencing those decisions as well. We have a booming, we predicted a booming secondary market, and a secondary market in terms of jewelry, secondhand jewelry that's resold by consumers to the market and traded, and I think that still holds true, particularly as rough production is at that lower level, fewer goods coming to the market, and the secondary market might prove to be a valuable resource for people, for consumers, and also an interesting one. I think you sometimes find the most interesting pieces in the secondary market. We spoke about a leaner and more efficient midstream in the previous slide. The issue of alternative financing, that the reliance on bank financing seems to be lower, because the banks have been very cautious about lending to the trade, and also in 2020 there was less of a need for bank financing. But with those factors has come up new ways of accessing finance for the industry as a whole, and I think that will develop, will be an interesting thing to watch, because I think there'll be even newer outlets for financing that will come on board that we haven't thought about. There's a greater reliance on technology. We just finished a 5-part series of podcasts where we outlined various aspects in which technology is influencing the trade, be it on a digital marketing point of view, from in grading, in manufacturing, at retail, it really, and in the mining sector certainly as well, in the rough market, technology is really being embraced and having an influence on how we do business moving forward. Ethical diamonds is the discussion around ethically sourced diamonds has really intensified over the last few years, and certainly in 2020 it was really a strong theme as people became more sensitive to various issues about our human relationships, our environment, etc. That the coronavirus certainly had that influence on us, but even beyond that, the way consumerism is moving, that source verification is a vital topic, and will be, I think, a hot topic in our newsfeed in this coming year and moving forward. We predicted last year that there would be a segmentation of lab-grown diamonds away from the natural diamond industry. I think we are starting to see that already, as we're seeing, firstly, more people getting involved in lab-grown, more manufacturers, more retailers getting involved and embracing lab-grown. That's on the one hand, and then also that diamond price, that lab-grown prices seem to have dropped in the last year as well. And so as lab-grown prices drop and natural diamond prices hold their value, we see an increased differentiation between those two markets, and I think that's only going to intensify over the next decade. And finally, that we're already seeing much more creative and interesting activity when it comes to marketing in the diamond and jewelry industry, and people and consumers are responding by relating to that personalized message, to that more focused message that the industry needs to engage the consumer with. And that's and that should only continue. It can only continue because the new age of social media marketing, of digital engagement, and buying online requires that. There's no going back. And so I'm very excited about some of the marketing campaigns that are out there. The Natural Diamond Council, I think, is doing a fantastic job of just refreshing the industry's message, and also among individual businesses, be they retailers, designers, even wholesalers, are really engaging with consumers in a much younger, fresher, and more sexy way in various online platforms, and I think that's very exciting. So I think we have a lot to look forward to, and I think that the industry is at a position where it has a platform from which it can build, and that's something to be optimistic about. I don't think we're out of the woods yet in terms of the coronavirus, and it will probably be a fairly volatile period still. But I do think the worst maybe is behind us, thank God, with as the vaccines are being rolled out. But when we look ahead, as long as the industry can maintain that supply-demand balance that it seemed to have achieved in 2020, I think we'll be okay, and we can look forward to a strong industry moving forward. So thank you very much. I hope your brain is not burnt from all the information that I've given you, and I hope you found it interesting. And if you have any, if you want to reach out to me, you can do so. I'm on Twitter, I'm on LinkedIn as well, and via email. I would also encourage you to look at our monthly research report, and I would like to also mention that in our January Rapaport magazine, we published our annual price report, which has a wealth of information about diamond pricing. It's got historical price points that are very useful to anyone in the industry, and I would encourage you to look at that in our Rapaport store. If you're a subscriber to the magazine, you should see that in the January issue. So thanks very much. That's my little plug. But thanks very much for listening, and I'm happy to take some questions now. So I'll look at the Q&A section of the Zoom app and see if we've got any questions. Okay, so the first question that I see is how many carats and dollars worth of rough do you estimate De Beers have in stock right now? Anglo-American, I think at the end of 2019, if I'm not mistaken, and you can fact check me on this, but Anglo-American published, which is the parent company of De Beers, published that they have inventory worth $500 million worth. It's $500 million, and they said the majority of that is in diamonds. Anglo American also has various other commodities, iron ore, platinum, etc. They said the majority was in diamonds, and that was the first time I actually remember having some reference point to inventory at De Beers. And so the short answer to your question is that that's probably changed in 2020. I think it probably went up a little bit, but I need to do I don't have enough information to give an exact answer to that question, because it's a closely guarded secret by De Beers. Alrosa does publish its inventory data, and as I said earlier, it stood at around 20 million carats at the end of 2020. Okay, so our next question is, how big a threat is lab-grown diamonds in the next few years to natural ones? And where do you see polished prices going in the next few years if things stay the way they are? Finally, will people keep on buying rough just for the sake of it? So there are three questions there. I'll deal with the lab-grown first. How big a threat is lab-grown? It's going to eat into a portion of natural diamonds. As I mentioned earlier about that argyle, those argyle goods, and I think that's an interesting thing. That if why for a jeweler might be enticing to buy to set their jewelry with a call it an H color VVS lab-grown diamond, whereas for the same price point or a cheaper price than they would otherwise fill that jewelry with a lower color and a lower clarity natural diamond. So I think there is going to be that dynamic, but I do think that it's as I said, they're going to differentiate into different markets. I think I am seeing a difference in philosophy of various lab-grown or diamond companies that have gone into lab-grown. And De Beers is on the one side saying that they're not at the moment. They're saying that they're not. It's not an engagement. It's not for the engagement market. It's a fun fashion jewelry product. And there's a set price. There's a stable price point because the cost is stable. The cost to manufacture lab-grown diamonds is stable. So they've set that price point at $800 a carat. It'll be interesting to see if they lower that price. I'm not sure. I don't believe they have, but I wonder if they will. Anyway, we'll see. Blue Nile has partnered with De Beers in putting their lab, that De Beers lab grown on their websites, and that's an interesting type. And then on the other side of the equation are other companies that continue to pin the price of a lab-grown diamond to the natural diamond. It's a percentage of 80% below wrap, whatever the case may be. And there is that school of thought within the lab-grown community that they are able to brand their products and sell that branded product as an engagement ring. And so there is a place in the market for lab-grown, but I do think that as prices come down and natural diamonds maintain their value, that the two markets will segment into two separate markets almost. To address your second question, where do you see polished prices going in the next few years if things stay as they are? I don't know. But again, I think the industry has found some balance, and I'm hoping between supply and demand, and I'm hoping that that's not a short-term moment that we're having, that can be sustained. I feel fairly optimistic that the mining companies are seeing that, because considering that lower production that we are expecting. So, but I can't predict price points, that's for sure. Where will people keep on buying rough just for the sake of it? Well, again, that's the question that we tried to address earlier. But I think that there's a cyclical nature to the market and to trading, and the first quarter will see that spike in rough sales, and then we'll see a lower level of rough sales in the second and third quarter. That pattern that I showed earlier in the De Beers and Alrosa graph. Let's see, what feedback have you had about sales for Chinese New Year and Valentine's Day? Very anecdotal feedback. Let's say that I wouldn't take this for the truth, but we actually had a discussion. We have a call within our various divisions and various offices every Wednesday to discuss what's happening in the market. And one of the points of feedback were that that we got from the US, our US office, that's spoken to various wholesalers, various retailers, is that Valentine's Day was fairly good. And usually Valentine's Day is a fashion jewelry holiday, and an interesting bit of feedback that our wonderful representative in the US got was that there was some momentum in engagement ring sales over Valentine's Day, and that's something that we're going to look into and sort of see if that was the case. And so it seems that Valentine's Day was fairly good for single stones, not necessarily good for single people, but but we'll move on from that. And in terms of the Chinese New Year, we don't have any feedback yet about jewelry sales, but we have seen some positive reports about general retail. There was an interesting government report today from the Commerce Department in China, saying that e-commerce in China is now 25% of total retail, and that's quite amazing. And China really has led the way, I think, in terms of consumerism online, and never mind just online, just particularly mobile, I think, and that's quite an amazing figure. If you think about jewelry, about Signet's online sales making up 23% of holiday sales, that retail as a whole in China is 25% is done online. It's quite a number, but we don't have direct feedback yet about the Chinese New Year. People are still on vacation in China for the Chinese New Year. We kind of think sometimes in the West, we kind of maybe somewhat naively and maybe even arrogantly think about the Chinese New Year coming, and that's when the sales will happen. But no, the sales, it's like if you think about Christmas, New Year, the sales happen in November, December, and then people take vacation in over the New Year period, and it's the same in China. And I believe that retail in mainland China is mainly still kind of on vacation at the moment. Okay, we'll take a few more questions if there are any. Okay, let's see. Gold rose by 50%, silver too. Stock market is rocking. Bitcoin going crazy, etc. And our product is maybe worth the same or somewhat less in most areas. Shouldn't miners control the supply further, not to be greedy? Should we be bullish with the amount of new wealth in past 12 months in the stock market? I do think that we need to be careful to compare diamonds to the movement in the stock market and also in other commodities, because if you take gold and silver as well, they're a traded commodity. They're a commodity that's traded online as well, and for investment purposes, the jewelry market is a big part of the gold and silver market, but it's not the whole story. The diamond industry really relies very much on consumer demand for jewelry, and so we can't make that comparison. Certainly not with the stock market, and certainly not with Bitcoin. That these investment tools are soaring, and so why haven't diamond prices moved in the same way? I think what's important about the diamond market that you can't say for you can't say for too many other products, is that it holds its it's, again, to quote Stephen Lucia from De Beers, it has a preciousness that holds value, and a sentimental value to it that not many other products can compare to. Who knows? Maybe Bitcoin will be a popular Valentine's Day gift at some point. I certainly wouldn't mind, at yesterday's prices, getting a Bitcoin from someone, or receiving a Bitcoin from someone. But anyway, I think and to the question about shouldn't miners control supply. I think they are being quite cautious about supply, as I showed earlier in the presentation. And the question is, what's going to happen with rough prices if mining companies are going to be greedy in raising prices to unsustainable levels? That's where the question goes. And if manufacturers are going to be going to blindly buy that rough, I don't feel like we're at that moment at the moment. Should we be bullish about the amount of new wealth in the past 12 months in the stock market? Yes, absolutely. I think we benefited already from that wealth. That retail. So I think and I think the January retail numbers from the US were out today, in fact, and I think the headline was that this stimulus payments boosted consumer confidence and spending in January. And I think the same applies to wealth in the stock market, that people that at least psychologically felt that they had more, had greater wealth, and were willing to spend on high-ticket items like jewelry. How do we see rough sales evolving over the next 5 years? Is the era of site holders over? So I don't think the era of site holders is over. We know that De Beers has made some changes to its site holder supply. It's categorizing its site holders into 3 different groups, being manufacturers, rough dealers, and retailers who buy rough. And the idea is to provide a more customized supply to each of those groups, so that it's more aligned with their demand, with the goods that they need. And the underlying message is that De Beers doesn't want goods to be flipped over and sent straight to the dealer market. They want more goods to be processed by their site holders. I think the question then arises is what happens to the dealer market, because the dealer market plays a very important role, both in the rough and the polished trade. And so we'll see what happens there. But I I would hope that the role of the dealer and the rough dealer is protected in that sense. Just back to that question, is that that we are seeing interesting developments in rough sales, more sort of, you know, more Serene Galaxy machines being used in the rough buying process, in online online rough sales, and also a drive to provide more bespoke rough according to the end polished needs. And I always refer to Lucara's Lucara Diamond company's Clara system, that that I think it'll be an interesting. 2020 was supposed to be the interesting test year, but that was put on hold for the Clara system. And the Clara system enables manufacturers to buy rough according to their real polished requirements are. And so we'll see if that takes off in this year, but I think that is the way of the future. But I don't think it's the end of site holders for now anyway. Anyway, let's see if there's just one more question, and then I think we'll wrap it up. Don't we need more marketing funded by all producing countries and major miners? Natural Diamond Council's funds are surely not enough. It should be 100% managed by outside professionals and not miners. I would have probably have agreed with you a year ago, but I'm really excited about the direction that the Natural Diamond Council is taking. I think they're proving that you don't need you don't necessarily need the big budget to run an effective marketing campaign and engage with consumers in today's world. You need dynamic content, and you need a fresh, young, sexy message, and they seem to have that. I really do encourage everyone to look at their publishing, the work that they're doing in publishing, and their website has really great articles on diamonds, on jewelry, on design, you know, across a broad spectrum. And we are not their audience. That's what we've got to remember. The audience is to get the message out about diamonds, and so I think we need to get out of this mindset about you know, that we want to see the Super Bowl ad, or that 2-minute video on YouTube that's, you know, talking about the romance of diamonds, blah blah blah. What's important is what's happening on Instagram, Twitter, on LinkedIn, on Facebook, on TikTok. That's what's important. On Pinterest. You know, and we got to take that message and copy it for our businesses, whether you're a jewelry designer, whether you're a manufacturer, whether you're a wholesaler, a retailer in business. You need to take a look at what the Natural Diamond Council is doing and apply and copy it, essentially. And in some cases, the NDC is working with retailers to improve their messaging, because that's what their role is. And so yeah, they're funded by the mining sector, but we got to give credit where it's due, and I really do like their messaging and the direction that it's moving. Okay, I think we've gone on for sure. It's already an hour and a half, so I apologize if I went on too long, but I hope you enjoyed it. I hope you gained a lot from our discussion. And again, feel free to reach out to me on various platforms, and some others that I need to up my game in. So stay safe, everyone. Stay healthy, and I wish you all a great success and happiness in 2021. We'll see you again in 2 to 3 months' time. Bye-bye.